Good afternoon and welcome to this lunchtime STEP talk hosted by STEP Bermuda and the Bermuda Business Development Agency. It's my pleasure to introduce our speakers today, John Riches and Samantha Morgan of RMW Law in London. So good afternoon to both John and Samantha. I was going to say from a sunny Bermuda, but of course it's just started to rain. We're very sorry, of course, that you're not with us here in person, given the current world circumstances. I've had the pleasure of working with John and Samantha for many years on a number of very interesting matters for international families who are doing private wealth planning. I think we couldn't have better speakers to give us a STEP talk today on the topic of trust and regulation, what is next. And so without further ado, I'm going to pass over to John and Samantha, who I think are going to take it in turns to present on those topics. And hopefully at the end, we will have some time for a short question and answer session. So John, perhaps you would take it away.
Yeah, thank you, Keith. And hello, everybody. Sorry not to be with you. As I look out of my window, there's snow on the ground and we have -9 Celsius forecast tonight. So I'm feeling warmed by the virtual background of Bermuda as we present today. Anyway, to get underway, I think a lot of what we're going to talk about today is to, as Keith said, to look at what's coming up on the regulatory transparency agenda. And in order to look forward, I think it's appropriate to first of all look back. And in that context, both Samantha and I have spent quite a lot of the last 10 or 12 years working with the Public Policy Committee of STEP, which I chaired until the end of December from its inception. And what we're going to try and do is make sense of some of the things that have happened in the past and then try and connect those with what we think, join up some dots to say what's going to be happening in the future. Because although you might feel that the world of CRS or AML or trust registers is somehow, initiative on initiative that are unconnected, I think what we hope to demonstrate is that there is a sort of a thread running through all of these areas that that helps you make sense of all of them because they are substantially interconnected. If we kind of think about maybe just the last 10 years and pace ourselves back to 2011, obviously at that point there was a sense that regulation and openness were on the agenda for governments, for supranational authorities, and there was perhaps an emerging sense that some jurisdictions, offshore jurisdictions like Bermuda, were seen as sort of pulling ahead in the in perception because of their high standards of compliance with international regulation. So there was a sort of sense that there were sort of better places to be, but by and large, the world was relatively still benign at that point in terms of how offshore was perceived. And I guess one area that we would also see is that the shop window of different jurisdictions in terms of initiatives on different areas like settle or directed trust or whatever, that was still emerging as and evolving as it is today. And so those were the sort of broad themes, but the regulatory piece was, although important, wasn't necessarily as front and center as it is today. So if we think about what was changing 10 years ago, I think it would be fair to say that perhaps next slide, please, Corinne, that there was very little prospective disclosure about offshore structures or beneficial owners. It was more after the fact, obviously in places like the UK or the US, if you received a distribution from a trust, then it was reportable, then you were obliged to say something about it. But there was no sort of other mechanism that cross-checked that unless people started looking at your bank account or started asking questions from a revenue authority. And I guess we were focusing a lot about new ideas, strategies for mitigating tax onshore, offshore, the arbitrage between them. And there was still a very big focus on using offshore structures to exploit opportunities around double tax treaties and different tax rules. And by and large, I would say that the most sort of sophistication that exists in terms of looking at offshore structures is mainly through the onshore lens of complex rules that look to track what was in an offshore trust, maybe as the rules that we are familiar with, that I'm sure you've seen in places like the UK and the US, where you try to track payments out of a trust with what's happened in its history in terms of its income and gains records. So that was sort of, if you like, where we started. But what I wanted to do next was just to sort of think about this central impact of anti-money laundering in all of this. And obviously the kind of compliance rules that you're all too familiar with, having spent something like 6 or 7 weeks trying to produce information on a new structure that we were setting up in an offshore jurisdiction, and the numbers of KYC and AML disclosures. Obviously, we're all too familiar with those today. But if you actually look back, and this goes right back to the sort of 30-year theme of 1990, it was only then that FATF first started looking at its recommendations for structuring. And then what we can see in the sort of red lettering here is the kind of interplay between FATF on the one hand and the EU on the other. And in the early stages of the EU's interest in anti-money laundering policy, the principal focus was around financial institutions. And if you look at the sort of first and second anti-money laundering directives, they didn't really affect those of us who are in, trust and company services or professional advisors. But I think the sort of the key development in anti-money laundering policy that we can see in 2005 was the introduction of the EU's third anti-money laundering directive that brought people in professions into the scope of having to identify clients and identify beneficial owners. And what's very telling, if you look at this slide, is that the developments that it took place between 2005 or looking backwards for 15 years, the pace of change started picking up very significantly. And you can see that on the right-hand side of the slide, that in the last 3 or 4 years, we've had 4th AMLD followed by 5th AMLD, hot on the heels really. So after a 10-year period, the sort of pause period between these changes at EU level has been quite significant in terms of speeding up the level of change. But probably the most critical development, I would say, in terms of the AML threads that we see today was the recommendations in 2012 by FATF that looked to identify, require customer due diligence, and then also look at identifying the ultimate beneficial owners between corporate structures and trusts. And so the interplay between FATF and its recommendations in the EU, I think if you put those together, those really do dominate the landscape in terms of changes on the anti-money laundering side. If we go next then to policy development by governments, it is actually 2013 and the then British Prime Minister David Cameron, who led a G8 summit in Northern Ireland that I think is probably the seminal moment in terms of the developments where all of the threads that we're going to be talking about today came together. And you'll see in the introduction to the Laundering Declaration that there was this focus on governments having a responsibility to promote good governance, and then a reference to fair taxes and increased transparency. So I think this was the sort of point that supercharged the interests in transparency in particular. So if we go to the sort of key recommendations and action points from the Laundering Declaration, you'll see that all of the things that we're worrying about today and that we're going to be sort of tracking forward are encapsulated in these action points. The first is that this focus on tax evasion and the requirement for automatic exchange of information to enable tax authorities cross-border to fight tax evasion. The second is basically where BEPS came from. It's this sort of requirement for country-by-country reporting and the interest that tax authorities have in looking at how multinationals should report to tax authorities where they pay tax. And finally, then, the third leg of the stool here is the requirement for third parties to know who owns companies, and for tax collectors and law enforcers to be able to have easy access to this information. And that obviously tracks forward to the question of trust and corporate registers that we're going to talk about in a moment. So what I'm going to now do is ask Samantha to talk a little bit about the AML side of this and the FATF recommendations in 2012, because they are, as I think I've said in my introduction, maybe the sort of golden thread that underpins a lot of the changes that we've seen and that are continuing to affect the future. So Sam, perhaps you can help us with it.
In the last 10 years, we've seen substantial changes in the AML regime. As John said, FATF introduced guidance on how to identify beneficial owners of trusts, which included protectors and natural persons exercising effective control. And then you had FATCA, which was introduced in 2010, where the US was trying to identify US beneficial owners of offshore structures, which was then extended by the Common Reporting Standard for the rest of the world, which, unlike FATCA, which is based very much on identifying taxpayers, CRS is based very much on AML regulations and identifies the similar people that were identified by FATF. So you're disclosing the beneficial owners of structures in accordance with AML rules rather than necessary tax rules. In the UK, for example, they adopted the PSC regime to identify people with control over companies. It doesn't quite follow the AML rules introduced by the 5th and 6th Anti-Money Laundering Directive, where you've got companies owned by trust, you are disclosing an awful lot of information about beneficial owners who don't necessarily have control. Should we go to the next slide, please? Then the other elements that we've seen, as John said, is that governments are wanting to be able to find out more information about how people devise their tax arrangements. The OECD adopted mandatory disclosure rules, which were effectively designed to make intermediaries who designed arrangements to avoid the Common Reporting Standard to have to disclose them to their tax authorities and disclose information about the taxpayers. The EU then adopted DAC 6, which required intermediaries to report cross-border arrangements where there is effective cross-border arrangements designed to avoid tax, really, but it's much wider than that. But they also wound into that the OECD mandatory disclosure rules, so that if you have an arrangement that is designed to conceal beneficial owners or avoid the Common Reporting Standard, that then falls also within DAC 6. The idea behind this was to enable the EU to identify, tax arrangements that people are putting in place early, discourage intermediaries from actually designing such arrangements, because the intermediary has to provide a lot of information about themselves and the taxpayers entering into such arrangements. What we're finding, that although DAC 6 was actually designed really for the multinationals in mind, what we're finding is that it's catching clients' private arrangements with trusts and companies, where they enter into fairly sort of standard cross-border arrangements, suddenly finding they're having to disclose information about the whole structure. We can go to the next slide, please. And what we're also finding is that, John said, typically people used to be able to put structures in different tax jurisdictions to take advantage of double tax treaties, to take advantage of the ability to reduce tax. Now we're seeing that clients are not able to do that. They have to be able to show that they've got substance in the offshore world. There are limitations on their ability to rely on double tax treaties. There are limitations on their abilities to deduct interest from debt and things like this. And now this is reinforced in Europe with DAC 6, where all these types of arrangements are now having to be disclosed. Again, we're seeing things that were designed for the corporate world, for the to avoid multinationals from avoiding tax, having now to sort of having to be dealt with in the private sphere. And the next slide, please. What we're seeing with offshore trusts and offshore structures, the tax rules in onshore jurisdictions were fairly sophisticated. As John said, the settlor would typically be taxed could be taxed on income and gains, and the beneficiaries would be taxed on distributions they received. We haven't seen that change substantially in the last 10 years. But what we are seeing now is historically, the tax authorities could only find out the information if the taxpayer told them. Now they're getting in the information from FATCA and CRS. They now have a lot more information, although, as we discussed recently with HMRC in relation to the CRS, the information they're getting doesn't necessarily identify in what capacity the person is being disclosed. And that is actually causing quite a headache, because we're having clients get inquiries from HMRC as to why this large amount of income has been declared in relation to them when they're only a protector or a trustee, for example, and not a beneficiary. And what we're seeing is that under DAC 6, for example, a lot more information about offshore structures may be disclosed simply because that offshore structure is involved in an arrangement that has a cross-border element. Next slide, please. The other thing we're seeing is the rules in relation to where our clients are living, where they're basing themselves, what they're looking at in terms of where they want to live. There were golden passports on the increase in Malta and Cyprus. We're seeing other jurisdictions have non-dom rules similar to the UK, encouraging people to come and live in the country, pay tax on their local income or only on foreign income to the extent they bring it into the UK. But what we are seeing is it's more difficult for clients to base themselves in a low tax jurisdiction, to become tax nomads. It's all becoming much more difficult simply because of the disclosure regimes, the amount of information they have to provide, and where their asset base is.
Yeah, I think it's interesting. Sorry, if we go back, just stay on that slide. We've just finished off a chapter for a book on mobility of high net worth individuals, and the core theme of that chapter is that the system doesn't want you to be a nomad, and certainly for common reporting standard purposes, they absolutely do not like banks and financial institutions will fall over backwards to report you in different places. And so, although there's a lot of urban myths out there about tax nomads, the smart money is on being in a place where you can be reported, rather than claiming to be nowhere, which will then leave you open to being reported in any place where you have a connection. So I think the sort of nomad issue will become a more challenging one as the sort of CRS things pick up. But Sam, it might be worth just going back on DAC 6, just sort of updating people on a kind of potential Brexit silver lining on DAC 6. That
yes, from a UK perspective, the only element of DAC 6 that we need to consider as UK intermediaries actually relates to the mandatory disclosure rules. They have adopted Hallmark D in the UK, but our understanding is that they will move towards adopting the MDR as opposed to Hallmark D, which is actually slightly different from MDR. However, although we ourselves don't have a reporting obligation for these cross-border arrangements, we are finding that we're having to look at them because clients have entered into them. And the default position seems to be that disclosure should be made, and a lot of disclosure should be made about the structure above the cross-border arrangement. So it's an area that I think we all really need to understand when we're putting in place arrangements for clients, to understand what kind of disclosure could be made.
Yeah, I think it's also the case, isn't it, Sam, that you've had examples of, if I can call it this, gold plating, where people in EU jurisdictions are looking to report if there's any, they don't really understand the rules, and so they're looking to over-report just to protect their position. And often when you push back, that's not really the case, that the disclosure is required.
Yeah, we've had to spend quite a lot of time explaining structures in a lot of detail, just to explain how they work and why there is no tax avoidance motive, and it's a lot of information you have to provide to get people comfortable that there's no reporting obligation.
Yeah. So if we can then just sort of say, well, let's press pause. Where are we today? Just a few sort of straws in the wind, but I think important points to think about here. The first is, I think that there's a sense that I've had from looking at what's been happening, that the EU has been driving a lot of this change. And on the transparency side, what's kind of interesting is that notwithstanding Brexit, the UK has been pretty on message and part of the sort of driving force for this within Europe. So the idea that I think the UK would depart from this line following Brexit, I think is unlikely, but there is a bit of sort of competition almost within supranational authorities between the EU's position on the one hand and say OECD's on the other. And when you come to issues like trust registers and things of that nature, which are quite sort of EU driven, it's interesting to note that OECD is less keen on, for example, the idea of public registers. They're very keen on the idea of disclosure to tax authorities, but they're not so positive about the idea that sort of public disclosure is the way forward. So there are sort of different strands that one can detect there. One huge point, and I think if you had to ask me what is the biggest likely challenge as we go forward in the next 10 years, is this, sorry, can we stay on that slide? Is the inequality question. And I'm sure you've seen writing about this, but obviously it's going to not be made better by COVID. But one of the things that is interesting, that if you look at continental European countries and their approach to trust, for example, is the question of attribution. And Sam, do you want to talk about our interesting case with the Netherlands, which is a recent example of that in terms of inheritance tax?
Yeah, it's been quite interesting. There's a lot of discussion that in the UK as to whether the UK could introduce a wealth tax, and how that would apply to trusts, and whether you would treat beneficiaries as sort of owner of the assets for wealth tax purposes, and they do in France for certain purposes. But we had a Dutch case where we were setting up a trust for two settlers who are based outside the Netherlands, but their daughter lives in the Netherlands, and we were advised that if they set up this trust for her benefit and then they died, she would be deemed to own a proportion of the assets equal to the number of siblings she had, and there was no sort of, the fact that she was merely a discretionary beneficiary, might never get anything, wasn't even actually named necessarily as a beneficiary, wouldn't help because she was treated as her parents' heir. And the only way we could avoid it was to create some kind of quite complex structure or actually exclude her wholly from benefit. So it's quite an interesting look at how other jurisdictions view trusts and effectively treat them as transparent.
Yeah, so I think that's a big concern for the future, to say, well, they're discretionary trusts, so how can anybody ever tax them? The answer is they would just deem them to be owned by the beneficiaries. So that's where the whole question of seeing who's on the register of a trust then becomes important. If you think about the world in a different lens and come out of the sort of bubble that we sit in Western Europe, I've always found it quite surprising that, for example, the Middle East and Asia, whilst they've signed on to AML policy, which is understandable, have also bought into sort of agenda on CRS, because by and large, if you look at those jurisdictions, they only tax people on a source basis in many cases, and they do not have inheritance taxes. And so unlike Western Europe, the upside for them in terms of information for tax purposes that's generated by this is actually perhaps not so useful as it would be in Western Europe, where you have tax on a sort of worldwide basis. So whether, if we look at different sort of trends here, that Asian jurisdictions, places like Singapore or Hong Kong, will follow suit in some of the issues that we're talking about, I think is a really big question for the future. One topical point at the moment is obviously the new transparency bill in the US that was introduced in the last couple of weeks of the Trump administration. And I think it's very interesting that after so many years of being sort of behind the curve on this, the US has bought into a federal corporate transparency measure, albeit that all of our kind of advisors there who we talk to are saying there's no way this is going to become public anytime soon, and that it is only affecting companies and not trusts. But the fact that the US has sort of fallen into line here after being the laggard for so long, I think is also evidence to the fact that they are wanting to sort of be part of the international community in this area. And I guess finally, the reputational implications of entering into what might be seen as legal but aggressive planning. It seems to me that compared with 10 years ago, clients have a much lower appetite for that. And I think if we look at the generational changes that are going on in the years ahead, that's only going to be reinforced. So against that sort of general agenda, maybe we can move on and look at transparency in particular. And Samantha, do you want to just talk about how we think the disclosure piece in particular will unpack?
Yeah, I mean, I think CRS and FATCA are here to stay, so we are going to be disclosing information to tax authorities. What we're seeing is that the trend for public registers and companies and trusts is increasing. At the moment, trusts are not generally public, but we're finding that certainly the EU jurisdictions adopting corporate registers where you've got a company owned by a trust, full information about the trust is effectively being requested and being disclosed. We don't see that changing. One of the issues that has come up in discussion is the extent to which people can rely on the information that is on these companies and trust registers, because they are actually, the company and the trust itself puts the information there. The 5MLD actually required people dealing with companies and trusts to actually check what's on the register and then challenge it or correct it if it's wrong. So they are effectively now trying to require people to have some kind of check as to what goes on. One of the discussions we had with FATF, there was a lot of discussion about how you can make a corporate register more accurate and actually, requiring perhaps a notary or a lawyer to validate what information goes on the corporate register each time. But at the moment, we're not there. As John said, the US is introducing centralized registers for companies. Nobody seems to know what information will go on there, particularly where the company, for example, is owned by a trust. We moved a Luxembourg company to Delaware at the end of last year, and nobody in Delaware asked us who the beneficial owner was. No KYC required, company registered quite happily. But I think that is changing. I think one of the things to think about is when you're drafting a trust or looking at restructuring a trust, is the amount of information that is available and the amount of information that could potentially be disclosed. So what we're seeing is that people are not, historically people would have quite a wide class of beneficiaries on the basis that you wanted lots of people to benefit. We're seeing people now actually sit back and think about who should be included in the class of beneficiaries. If they are going to include, children with motor issue, whether you actually include them at the outset or include them at the later age when you're actually only intending to benefit them. We're looking at people thinking much more about governance arrangements, bearing in mind, who might be identified on a public register, and just making sure that everybody understands what it is that will be disclosed, and what it is will be in the public domain. As I said, one of the issues in relation to CRS is it does rely on AML rules, and so as AML rules adapt and change, it could be interesting to see whether the CRS will change with it. If you go to the next slide.
Oh, sorry, can we just pick up one thing on there, Sam? If we can go back, apologies. On the one thing that is tucked away a bit, and but is I think a kind of an interesting example of what Sam's just mentioned about the interplay between AML and CRS, is that to be specific, the CRS rules say that the people who are treated as beneficial owners for AML purposes are treated as controlling persons for CRS purposes. So there's a dynamic interplay where what if the AML rules change, it will have a direct impact on CRS. And at the moment, OECD has just started a review of CRS. We gave some input to the UK government or HMRC for some meetings that are taking place later in February about this. But one thing in particular that's not been picked up to any large measure, but I think is quite important, is that in the FATF rules, if you go back to recommendation 10 of 2012, you have the list of characters you identify for trusts. And I'm sure you all know the kind of, I can do this in my sleep, SEC law, trustees, beneficiaries, protectors. And then the fifth category is other natural persons exercising effective control. And when we were part of the sort of private sector group that was reviewing FATF's guidance in 2019, which hadn't been updated for some 11 years, we did say to FATF, well, how come you've never defined what is a natural person exercising effective control? And the mindset of FATF at that point was, well, we like to keep these things general because then people don't know quite where the boundaries are, so they will be inclined to report. And we said, well, it doesn't really work that way in our world. You need some greater clarity. And so if you look at the appendix to the TCSP guidance in 2019, you'll see where FATF landed in looking at this question of who is a controller for short. And surprisingly, lots of the arguments that people have used in the CRS context about, I'm one of 3 people on a committee, I don't control anything because there's 3 of us. The answer is, no, that's not right. You attribute all of the powers of the committee to everybody, or I have only certain powers to intervene in certain circumstances, maybe veto powers, that you could still be a controller. So I think if, and to the extent that those measures start to be focused on in this new review of CRS, which we understand will take place over the next 12 to 18 months and then sort of come in towards the end of 2023, I think you might find that lots of the, if I can call it this, indirect arrangements that exist, where perhaps you've got independent protectors, but maybe family members who can appoint protectors, you might find that those arrangements will somehow be drawn into AML reporting, and as a result of that, the CRS reporting profile of the structure could change. So I think in thinking about these governance arrangements, it's not just enough to say, where are we today? It's a question of saying, where will we be in 5 years' time? And do we want to take that into account in terms of how we modify existing arrangements or set new ones up? Okay, let's move on to the question of new tax arrangements. Sam, do you just want to pick this one up?
Yeah. What we've found in the last few years is that there's very little public difference in views as to what's actually sort of tax avoidance and what's tax evasion. For the last 10 years or so, we've actually seen clients being very anti sort of aggressive tax arrangements. We're seeing them looking for a much simpler life, simpler structures, and I think that that's actually going to continue. I think it's going to be important to make sure that you keep your structure clear, and artificial tax arrangements or arrangements designed to hide beneficial owners should, you need to avoid those type of arrangements. If they're not going to be disclosed by somebody, you're going to cause problems for your clients going forward. Will the DAX 6 model be copied outside the EU? It's an incredibly complicated piece of legislation, to be honest. Having spent the last year and a half looking at it and trying to work out what it meant and how we would apply it in a private client world, it's extremely difficult. I think it's highly unlikely that it would be adopted in the, well, I hope it's highly unlikely it'd be adopted in the model it is, simply because the amount of disclosure that is potentially required to be made. And I think a lot of it, certainly looking at some of the structures we've had to look at in the last few months, it doesn't help the EU. It doesn't provide any useful information. You've just fallen within the rules and you have to make that kind of disclosure. Will the emphasis for clients be more about avoiding extra tax than minimizing tax? I'm just seeing clients keep, quite a lot of clients now like a simple life. They actually accept, the majority of my clients accept that they're going to pay some tax. They're happy to pay some tax. They get more uncomfortable where an awful lot of disclosure is made and they're paying excess tax in jurisdictions where they don't expect to. So I think keeping structures simple and keeping arrangements simple is actually the way we see the world going.
Great. So do you want to pick this one up as well, Kat?
Yeah, put up this one. As I say, one of the issues that we're coming up against with clients is where their structures are based. There was quite a lot of, historically clients would set up arrangements in onshore jurisdictions like Luxembourg. They are finding Luxembourg difficult to deal with now simply because of the amount of disclosure that's required in dealing with Luxembourg. The tax rules have changed substantially. DAC 6 has now come in, which means any arrangement through a Luxembourg company is now cross-border. We're seeing clients move away from using those types of onshore arrangements. We're also seeing clients more uncomfortable using offshore arrangements. We've had clients have to move entities because they cannot satisfy the substance rules. We've had clients move entities because they're worried that the entity is in a jurisdiction which could be blacklisted in the EU, which could inadvertently give rise to higher tax rates, more reporting under DAC 6. So we're actually seeing clients looking for alternatives, moving structures to the US where they may be sort of onshore but not taxable. We've seen clients move structures to Singapore where they can take advantage of some of the tax regimes. We've seen clients move them to places like Liechtenstein and take advantage of the private asset structure regime. So there are fewer places clients now can go to set up these structures. We are seeing them move structures much more, the whole structure will be in one jurisdiction rather than a trust in one jurisdiction, a company in the BVI, for example. We are seeing clients more interested in looking at sort of midshore, onshore type arrangements. We are seeing clients accept there has to be more substance and more rigor around structures, which is a good thing because we're seeing structures run properly and not just companies where the clients historically treat it like a bank account with no proper directors and no proper decision making. We're seeing much less of that. So I think yes, we're seeing the structures being more simple, but we are seeing more substance and more robustness, and then looking at alternative jurisdictions to set these up in.
Thanks, Sam. So so I think we've picked up on some of these themes already, but if we then turn the lens back onto onshore, then the concern is that there'll be an increased sophistication of tax rules driven by the greater knowledge that exists around through CRS reporting, and this idea of attribution that Samantha mentioned with the Netherlands, I think is a coming issue. One thing that's kind of interesting there is in December, in fact, there was a report sponsored by the LSE that came under the confusing title, was published under the confusing title of the Wealth Tax Commission, which sounds vaguely official, but it was nothing to do with government at all. And that has a very interesting chapter on trusts and how attribution could be introduced into trusts, both onshore and offshore in the UK, that was written by Emma Chamberlain, who's a very sophisticated, well-known tax barrister who's written widely on this topic. And I would say that in the UK, the last time they looked at wealth taxes was in the mid-70s with something called the Mead Report, that if there is a change in the political environment in the UK, I don't think wealth taxes are imminent, but in the next 5 years, I wouldn't be surprised to see those ideas gain currency. So in that connection, the theme of that we've mentioned of not assuming that your discretionary trust will be a complete protection for non-set laws. Obviously for set laws, there's a tendency to look through trusts anyway in the set laws to treat them as the set law's own assets. But I think that's something that could well be happening sooner rather than later. And so watch this space on that particular issue. So if we go to the next slide, and I think this is thinking about what's happening on the public perception of offshore structures. Is there going to be any change there? It feels like in the short term that may be unlikely. I think one, I did see my good friend Clive Harrison put a question on which I'll try and pick up now, Clive. It's an interesting one, which is what's going to happen in the EU as a result of the UK's withdrawal after Brexit. And we've already seen the European Parliament make some aggressive measures calling for blacklisting. And there is a sort of an animus towards the CDOTs, I would say, that has been apparent over the years within the European Parliament in particular, that means that, with the UK not there, although there are other trust jurisdictions in the EU, notably Ireland, Malta, and Cyprus, it's something that is a point of concern. So I think the EU is going to continue to drive concerns around offshore structures. And Sam's mentioned the sort of midshore theme. I mean, one interesting thing we've started to see is the emergence of Liechtenstein, which obviously for many years had a bad press, but is kind of interesting because it sits within the golden circle of the EU. So it does have its own trust register, but it's hard for the EU to take measures against Liechtenstein because it's part of the European Economic Area with Norway and Iceland. So there are nuances there where I think European jurisdictions may become more attractive if they are seen as less as more mid-shore than traditional offshore jurisdictions such as Bermuda. But so that's one which I think policymakers in Bermuda will need to watch out for, because what we see very strongly is the high standards of regulation that you adopt and compliance with international directives are not ones that are respected in some of these jurisdictions to the same degree, even though they are perceived as more sort of less aggressive. So whether the sort of true position will emerge there, hard to say, but I think you need to keep obviously telling people all the good things that you're doing. I guess the big question that we see, Sam, a little bit in this area of information is the question of trust registers that you touched on earlier and the interplay with corporate registers. Do you just want to mention a little bit about, to reassure people about the business relationship point that emerged last year, and then hopefully,
no, I mean, our clients' concern about trust and company registers, they're quite happy for the information to be disclosed to the tax authorities on the whole, but they are nervous about the information going on the public register. When 5MLD required trusts to each jurisdiction to introduce trust registers for trusts effectively resident in the jurisdiction, it wasn't exactly clear how that would apply in all circumstances, because if the trust didn't have a UK trustee, it could also go on the UK trust register, apparently, where the trustee entered into a business relationship with somebody in the UK, like a lawyer or an accountant. And our concern was that, if you had a Bermuda trustee who seeks advice on UK tax issues for the beneficiaries, you would suddenly find that the Bermuda trustee ends up on the UK trust register, which didn't seem sensible because it had otherwise had no connection really with the UK. We had quite back and forth with HMRC, and in the end they actually adopted a rule which effectively said that would only happen where you had a UK trustee as well. So just because you have a foreign trust entering into business relationship with a UK person won't bring the trust into the UK trust register. Other EU jurisdictions have adopted 5MLD as it is, but seem to suggest that if you have a business relationship, it's got to be a long-term type relationship. But it's an area to be aware of, that if you are a trustee and you're taking advice or entering into a business relationship with somebody in an EU jurisdiction, you could end up on an EU trust register depending on how they've adopted the rules. The same rules don't apply if your underlying company enters into the relationship with the advisor. So it doesn't quite make sense. But the UK has taken a pragmatic approach, which is useful.
Yeah.
I think that the major concern, though, is the amount of information that's going on where you've got an EU company that is owned by a trust, and just the level of disclosure that's now being required about beneficiaries who may not have any kind of real financial interest and certainly have no control.
Great. So thanks, Sam. If we think about what we might do in the future and what are the sort of questions we should be asking now, then I think we're finding quite a bit in terms of kicking the tires on existing structures and looking at their fitness for purpose. Then you need to look at the tax and disclosure lenses and outcomes now, and then look at what might be coming over the horizon. And very much, as Samantha was suggesting, where there's complexity, stripping things down to fewer layers and things that can be justified, because sometimes there are legacy issues where you've had layers that are no longer required, and sometimes it's actually appropriate to get rid of those. In other cases, we call this the demise of the BVI company. I think consolidating into a single jurisdiction, from the point of view of the number of moving parts, the number of sorts of compliance and regimes you have to comply with, is very much a theme that I'm sure you're seeing, but we're seeing as well a lot of redomiciliations out of BVI and Luxembourg, I guess, would be thematic. And then just thinking about that, what's the overall jurisdictional footprint of the structure, and what's the disclosure footprint? And for example, if you're thinking about governance, we've seen a lot of structures where, in the old days, it was easy to give the families all the powers under the sun. And now the question is, are they quite comfortable with a professional protector who could, sit in a structure and be their sort of sounding board if they're unhappy? Sometimes we've seen models where you have, if I can call it this, hire but not fire powers for families, so that you don't give the families immediate sort of execution powers over protectors, but you give them the ability to appoint people for a fixed term of office, so that you can differentiate between governance and interplay in those arrangements and de facto control. So I think in the future, the sort of more subtle means of using arrangements would be good. And I guess, Sam, one thing we see a little bit of is, if I can call it this, the empty protector's chair is becoming more popular.
We're seeing clients, really, clients really want a protector to fire the trustee if the family lose trust and confidence in the trustee. Because if they've got a trustee they trust, having a protector double guess everything that the trustee doesn't tend to add that much, to be honest. So what we're finding is, the clients don't actually want to appoint the protector unless or until they do fall out with their trustee. And so the trust might provide for the appointment of a protector, but one won't necessarily be appointed at the outset.
Yeah. So just to conclude then, and before we throw open to questions, I think one of the big questions is the challenge we all face is can we basically restart the dialogue with those who are maybe cynical and say, look, actually trusts have got some really good uses, and they're not about tax evasion. Many times now when we're seeing trusts being used, they're used for business governance, for families where tax is not a driver. This is a bit of a plug, but if you look on the STEP website, you'll see that we've recently just issued a report that was commissioned, which is currently UK centric, but it does cover a lot of issues around why trusts are good things. And I think that the initiative within STEP is going to be to sort of enable people to adopt those in their own jurisdiction and develop their own version of that, so that we've got the ability to articulate to people that actually, on the whole, good substantial planning, succession planning with structuring is actually in the public interests as well as in the interests of families. So that's a challenge for the future, but perhaps on that sort of more strategic note, we'll conclude our remarks and invite you to throw some questions at us.
Yes, John, I don't know whether I've been unmuted by the BDA. Can you hear me?
Yeah.
Yeah. Many thanks for that, indeed. I just wanted to explore this point around protectors and the CRS in the context of financial institution trust. And I appreciate that you did talk us through that to some degree. When you're public chair of the STEP's Public Policy Committee, you wrote a number of, you contributed quite a lot to the discussion in this area, including that the CRS and Trust STEP guidance of March 2017, where I think your view was that it's still until the CRS and its commentary itself were amended, notwithstanding comments otherwise in the frequently asked questions and handbooks, that it was a defensible argument that protectors of financial institution trusts ought not to, by default, be regarded as account holders. And from the discussion just now, I appreciate there's been that AML thread seems to have become clearer. And with the OECD review of CRS on the horizon, that what may have been a defensible position, its days may be numbered. I was just wondering if you would like to explore that a little further.
Sure, I'll kick this off, and I'm sure Sam might have some comments on this, Ashley, as well. But yeah, so if you look at the conceptual position, as you say, effectively the CRS guidance differentiates confusingly between the situation of trusts which are passive NFEs, where there isn't an FI trustee, where the controlling persons include protectors, and then the list of individuals who are account holders for FIs or equity interest holders, to use the kind of terminology, where protectors are not included. But what I've always thought here is that you have to look at the substance, look behind the name to the substance, in the sense that, you might have somebody who's called an enforcer rather than a protector if it's a purpose trust. Do they have the power to hire and fire the trustee? Then in light of the more updated FATF guidance that I was referencing from 2019, I think you'd be hard pushed to put the position that the protector with a higher firepower over trustees was not to be viewed as an account holder under the residual category. However, if the protector's role was just to maybe exercise sort of certain veto powers over things like the sale of important interests in a trust asset or whatever, then maybe you can take a different position. So my own feeling is that the source doctrine here that I mentioned, that goes back to the FATF 2012, is that there's this huge imbalance between trusts and companies, because, as I'm sure you're aware, you look at the percentage interest that somebody has in a company, and if it's less than 25%, if it's normal, or if it's high risk, then maybe you go to 10%, you don't even look at it. And so the confusion is that in importing those rules for companies and treating trusts sort of like companies under the FATF recommendations, and then sort of treating like trusts like bank accounts, you end up with a position of the scattergun approach, where you have to include everyone, including protectors. And so I think essentially this was a drafting error by the draftsman of CRS, that they should have included protectors automatically. And so I think the days of taking that position are likely to be relatively numbered in the future, particularly when we have the 2023 sort of rewrite of CRS. I'm sure we'll see the standard changing this point. I don't know what your thoughts are, Sam, but that would be my.
Yeah, I think that's the way it's going. I mean, one of the other issues we've come up against in looking at CRS and the guidance is how you deal with corporate, private trust companies and corporate protectors, because the guidance in CRS isn't very, very clear, and we're actually finding it quite difficult to work out who you are meant to disclose when you've got a private trust company or you've got a corporate protector. So we're hoping that we'll get more guidance on some of those types of issues.
Yeah. but because you've also got that weird point, haven't you, about, for example, which I think we've drawn to the UK government's attention, you get some very strange outcomes if you have a corporate protector that's owned by a trust company, as part of its business. Sometimes you can end up in certain CRS cases having to name the shareholders in the corporate protector under CRS, even though they have absolutely no connection with the structure at all. So the outcomes of always looking to the ultimate controlling individual at the top of the chain can actually be, they can result in the wrong outcome quite a lot. And we see this also in the UK PSC register. So quite how you solve those particular issues easily, I think it's going to be a challenge, because the overlay of trust on companies, as Samantha said earlier, sometimes generates some pretty weird outcomes.
Yeah.
Many thanks. In your talk, you were exploring how a number of families are looking to mid-shore jurisdictions, perhaps in part because of the risk that of offshore jurisdictions may appear on blacklists, and that leads to some undesirable disclosure consequences. In the context of your discussion today, what policies and laws and approaches do you think that offshore, what are traditionally known as offshore jurisdictions, should consider? Should they, if it's at all possible, despite the geography, is there a way of positioning themselves to perhaps adopt more mid-shore qualities, or is there some other approaches that they might consider?
That's a great question, Ash. I mean, I actually think it's pretty hard to see what more you can do in traditional offshore jurisdictions that are highly regulated, because, I mean, for example, let's look at the substance rules. Those are not, as I'm sure you're aware, that the source of those is EU practice and recommendation. They're actually not, there's no law behind it. It's just the EU sort of throwing its weight around. And so I think the real question is, the fact that in the CDOTs, you've got this position of the UK government, which is kind of intriguing, where a couple of years ago, as I'm sure you're aware, they came out with this idea that there's this global standard for public beneficial ownership registers that will apply by 2023. And now they've conceded that won't be a global standard, but it's still being imposed upon the CDOTs, whereas, a lot of competitor jurisdictions don't have it. So I think all you can do is embrace the positives of that and say that we're an open place to do business. And obviously, I know, for example, in Bermuda, you've always had beneficial ownership checking of people using Bermuda companies right from the word go. So I think you've really got to sort of embrace the issues around high standards of regulation. And other than changing tax policy to introduce some sort of local tax, it's difficult to see what more you can do other than continue to do things to a high standard, I would say. But I'm not sure if you've got any pearls of wisdom there, Sam.
No, I'm with you. It's very difficult to see what else you can do. I mean, the offshore jurisdictions have a much higher, that they've been compliant with AML for a very long time. The AML tests are very strict, but it doesn't seem to be accepted. You all seem to be treated as a high-risk jurisdiction when dealing with onshore jurisdictions where the AML rules don't seem to be as strict. So it's quite difficult to see what can be done other than do, as John says, to keep the high standards that you currently have.
Many thanks. And what may be my last question, Sam, I think that you mentioned with the EU directive, trust registers presently are largely private. And I appreciate that there are some circumstances where that may not be the case, but company registers are not private. And then we run into this situation where there's an underlying company of a trust.
Yeah.
And the result of that is that the protectors, settler beneficiaries appear on the register, or is there an avenue to seek a legitimate oppose.
There are two arguments. There are two arguments that I've seen put against what goes on the register. The first one is under the directive, you can apply to the jurisdiction and say that going on the register would be detrimental. Certainly, the clients I had who put this forward to Luxembourg, for example, you actually had to show some real risk, not just opposed to I've got a lot of money and therefore I'm potentially exposed. That wasn't enough. We did take advice in Luxembourg though, with one particular structure where the advice in Luxembourg was we did not have to put all the information on the register based on a sort of general review of how the rules worked. So it's a difficult one to run with. There's not a great deal of guidance out there as to what exactly you need to put on where you've got a trust with discretionary beneficiaries, and none of them have any interest. So it's good to take proper advice, but the risk is that you could end up disclosing everybody. One of my clients, they were disclosing their children who were 18, didn't know anything about the trust, never received any distributions, and would never, while the father was alive, actually receive any distributions. So in those circumstances, we've seen clients relook at their class of beneficiaries to say, look, these children are never going to benefit during my lifetime, so we'll take them out and they'll only be added back when they're actually going to benefit. So it's issues like that we're seeing, but that's the concern, that the clients just find a lot of information goes on the register, and we have seen that kind of information being used to effectively blackmail clients, for the want of a better way of putting it. So it's not being necessarily used to find out who owns a company for a good purpose. It's being used for purposes that it was never designed to do.
Yeah, and just one chilling tale of that. We had a client where somebody who was, looking at some issues around the structure, who was investigative journalist type thing, where there was absolutely a complete legitimate structure. They used the interplay of beneficial ownership registers for companies between two jurisdictions to piece together some information that was not easy to find, but then drew some inferences from it that were wrong. But the trouble is, once they've sort of drawn those inferences and started corresponding on that basis, it's very hard to nail the lie. So I think the question of the profile of operating businesses in jurisdictions with public registers and where trusts are used becomes an increasingly sensitive question. And I think that maybe that's a point to pause on. I saw a question that was saying, which I think I agree with, which was saying, or a statement to say, look, you've got to select your intermediaries, your banks, your advisors very carefully, so that people who understand the sort of depth and complexity of these issues are the ones that you're working with, because you do not want people who are gold plating their reporting for defensive purposes. You want people who will take a correct but sensible, pragmatic view on these issues as you go forward.
And you also want, what we're seeing clients ask from their trustees and service providers like this is to actually understand what information is being disclosed about them. I've had a couple of clients who suddenly, who found that information has been disclosed and nobody's ever told them. So they are then in a difficult position when the tax authorities come and say, well, we've got this information about you, and they don't know what it relates to. So I think that's an important thing that we're seeing clients see as a key issue when building up relationships with people.
One of my observations is, well, presently most Bermuda and most of the jurisdictions you might regard as offshore have registers of beneficial owners of companies and perhaps partnerships, but those not registers of trust, and also those registers are private. But I have noticed that there's different approaches between the offshore jurisdictions in terms of who may be disclosed where there's a trust in the structure. Some jurisdictions being more prescriptive than others. So that might be an interesting point for family offices to consider when considering jurisdictions. But it also may be an area that may evolve.
I agree. Yeah, I think that it will come under increasing scrutiny as we get towards 2023, and if there are nuances between the CDOTs, then I think I agree that will become of increasing relevance to families in choosing jurisdictions.
Many thanks. Unless there's any more questions, or the Business Bermuda Development Agency wanted to make any closing comments, my closing comment is to thank you very much for making yourselves available and presenting on what is a very interesting area. I'm sure that we've had a number of people tune into this today. So thank you.
Great. Well, it's a pleasure to share some time with you, and we look forward to maybe being with you in person when the world normalizes a bit more